Welcome back to Crypto Macro Insights. I'm Maya, and it's Friday, August 29th, 2025. Tom, we're witnessing the final escalation of the reverse repo collapse story we've been tracking. The facility has now dropped to just $31.97 billion. That's an 86.4% collapse in 6 months, representing nearly $200 billion in fresh liquidity flooding the system. Meanwhile, retail sentiment has reached what can only be described as complete psychological breakdown, yet Bitcoin holds remarkably steady at 112K. With critical employment data just 6 days away, are we approaching the ultimate inflection point?
Maya, this is it. We're witnessing the crescendo of the most extraordinary monetary accommodation in modern history meeting absolute retail capitulation. That $31.97 billion in reverse repos represents the lowest level since the Fed started aggressive QT. We're looking at nearly $200 billion that has nowhere to go but risk assets. The timing is perfect. Retail is completely broken psychologically. Institutions are calm with the VIX at 14.85, and the yield curve continues steepening to 0.6%, signaling economic normalization rather than recession. This setup is unprecedented in Bitcoin's 16-year history.
Let's dive into that retail breakdown you mentioned. I'm seeing posts that go beyond the usual complaints. We have someone saying their cat died in January and Bitcoin hasn't done anything since November 2024, expressing genuine suicidal thoughts. Others are rotating into gold mining stocks, completely giving up on crypto. There's talk about missing every major pump: Bitcoin, XRP, Ethereum, now PYTH. The psychological state seems to have moved from anger to despair to complete resignation. Is this the kind of sentiment that marks major bottoms?
Maya, this is textbook final stage capitulation psychology. When retail investors are expressing genuine despair, not just frustration but actual thoughts of self-harm, while simultaneously the macro backdrop provides the most supportive environment in years, you have the perfect contrarian setup. The PYTH versus Link sentiment is particularly telling. Retail is chasing momentum in smaller cap Oracle tokens while completely ignoring that Chainlink just announced a partnership with the U.S. Department of Commerce. This disconnect between fundamentals and sentiment is exactly what creates the most explosive opportunities. We're seeing peak emotional decision-making just as the data suggests an imminent catalyst.
Let's get granular on those macro conditions. The reverse repo facility dropping to $31.97 billion is the headline number, but what are the other indicators telling us? I see the VIX has compressed even further to 14.85, and the yield curve steepening continues with the 10-year minus 2-year spread now at 0.6%. How do you read this constellation of data points?
This is the most bullish macro constellation I've seen in years, Maya. That VIX compression to 14.85 is telling us that institutional money isn't hedging for downside risk, they're positioned for upside. The yield curve steepening to 0.6% is crucial. It's up 140% in 6 months, signaling that bond markets expect economic expansion, not contraction. When you combine this with the federal funds rate holding steady at 4.33%, we have accommodative financial conditions with growth expectations. Bitcoin has held remarkably well at 112K despite all the retail psychological trauma. The smart money accumulation pattern is obvious. Institutions are absorbing retail selling, while retail focuses on meme rotations like PYTH pumping 90% in a week.
Speaking of timing, we're now just 6 days away from that critical employment situation release on September 5th, with the ADP report on September 4th as a preview. You've been calling this the make-or-break moment for this entire thesis. With everything we've discussed, the liquidity flood, the retail capitulation, the institutional calm, how are you thinking about these dates now? Has your conviction changed from yesterday's 50% bull case probability?
Maya, I'm increasing conviction again, from 50% to 55% on the bull case. Here's the key insight. The employment data doesn't need to be catastrophically weak. With retail this broken psychologically and $200 billion in liquidity ready to deploy, even marginally disappointing employment numbers could trigger massive flows. The Fed has been looking for any excuse to maintain accommodation, and disappointing jobs data gives them perfect cover. What's more significant is Bitcoin's price action. Holding 112K despite maximum psychological pressure suggests institutional accumulation is intensifying. If we get weak employment data and Bitcoin breaks above 115K, we could see the most violent short squeeze in crypto history.
Let's talk strategy for our listeners. With this unprecedented setup, maximum liquidity accommodation, maximum retail despair, institutional positioning, and a clear catalyst 6 days away, how should traders be thinking about the next week? What are the key levels and scenarios to watch?
The setup is clear, Maya. Bull scenario, 55% probability. Weak employment data on September 4th to 5th combined with Bitcoin breaking and holding above 115K triggers institutional FOMO and retail short covering. Target would be 130K to 140K within 2 to 3 weeks. Base scenario, 30% probability. Mixed employment data, Bitcoin continues sideways around 112K for another month. Bear scenario, 15% probability. Strong employment data forces hawkish Fed pivot. Bitcoin tests 95K to 100K support. The key is position sizing for maximum asymmetry. Small positions can capture the bull scenario's potential 20 to 25% move, but the real opportunity is the timing. If we get the setup next Friday, this could be the trade of the decade.
You mentioned position sizing for asymmetry. In such an extreme environment with maximum retail capitulation and unprecedented liquidity conditions, what risk management principles should traders follow? How do you balance the potential for this historic opportunity against the possibility that the setup doesn't materialize?
This is critical, Maya. The extreme nature of this setup demands equally extreme discipline. Position sizes should be 3 to 5% maximum, enough to capture life-changing returns if the bull scenario plays out, but not enough to cause financial ruin if it doesn't. Stop losses should be tight, below 108K for Bitcoin positions, because if it breaks that level, the institutional accumulation thesis is invalidated. The key insight is that with $200 billion in fresh liquidity and retail capitulation this extreme, the move, if it comes, will be violent and fast. You don't need big size to benefit. The bigger risk is emotional, watching potential gains evaporate if you're over-leveraged and forced to exit early.
Tom, as we approach what could be the most significant week in Bitcoin's recent history, if you had to give our listeners one final insight combining the unprecedented liquidity conditions, the complete retail capitulation, the institutional positioning, and the approaching catalyst, what would be your key message?
Maya, we're witnessing the convergence of multiple once-in-a-decade events. Nearly $200 billion in fresh liquidity has flooded the system through reverse repo collapse. Retail psychology has reached genuine despair, people talking about suicide over crypto losses while institutions remain calm. The VIX at 14.85 tells us smart money isn't hedging for downside. And in 6 days, we get employment data that could provide the Fed perfect cover to maintain accommodation. If the stars align, weak jobs data and Bitcoin breaking 115K, we could see the most asymmetric trade in crypto history. But the window is narrow. This setup has been building for months, and it will resolve one way or another within the next 2 weeks. The opportunity cost of not being positioned is potentially enormous.
Powerful analysis as always, Tom. To summarize for our listeners, we have reached the culmination of the most extreme liquidity injection in modern history, reverse repos at just $31.97 billion, down 86.4% in 6 months, representing nearly $200 billion in fresh liquidity. Retail psychology has reached genuine despair levels while institutions remain positioned for upside with the VIX at historic lows of 14.85. The yield curve steepening to 0.6% signals growth expectations, not recession. Bitcoin's resilience at $112,000 despite maximum psychological pressure suggests smart money accumulation. The catalyst comes September 4th to 5th with employment data that could provide the Fed perfect justification for continued accommodation. If we get weak jobs numbers and Bitcoin breaks $115,000, we could witness the most asymmetric opportunity in crypto history. But remember, extreme setups require extreme discipline in position sizing and risk management. We'll be back Monday to track these extraordinary developments as they unfold toward what could be the trade of the decade. Until then, stay disciplined, stay positioned, and keep your eyes on September 4th.